Let's talk taxes on your terms, making the most of Roth conversions. A lot of people assume that once they retire, their tax situation gets simpler. But for many retirees, that's when the complexity actually begins. That's because most retirement income isn't all that straightforward, and how and when you draw it can have a lasting impact on your total tax burden. Roth conversions are one of the most powerful and most misunderstood tools for long-term tax planning. And while they aren't the right move for everyone, they can make a huge difference when used intentionally. Let's walk through what a Roth conversion really is, when it might make sense, and how we help clients put this strategy to work. So, what is a Roth conversion? A Roth conversion is a process of moving money from a tax-deferred account, like a traditional IRA or 401k, into a Roth IRA. When you do that, you pay tax on the amount you convert, but from that point forward, it grows tax-free. No required minimum distributions, no taxes on future withdrawals, and no tax impact for your heirs. It's not a loophole, it's not a trick, it's simply a way to reposition your assets now so they're more tax efficient later. Most retirees have the majority of their assets sitting in tax-deferred accounts, and every dollar in those accounts is eventually going to be taxed. The question is, on whose terms? Do you want to let the IRS decide when and how much gets taxed through required minimum distributions and future bracket changes? Or do you want to take control and be the one who decides through intentionally planning for when that money gets taxed? That's what a Roth conversion allows you to do. Not everyone should convert, but for some people, the timing is ideal. Here are a few common situations where we've seen it work well. Early retirement years. Let's say you retire in your early 60s but don't start Social Security or pension income right away. That creates a gap, a window of time where your income is lower than it will be later, especially before RMDs kick in at age 73. You can use that window to convert small portions of your IRA into a Roth IRA each year, staying within a reasonable tax bracket. You're filling up the lower brackets with intention. Market pullbacks. Even though the market has recovered recently, pullbacks still happen. And when they do, converting assets at temporarily lower values can reduce your tax bill on the conversion, while still participating in future tax-free growth. Planning for RMDs. At age 73, RMDs become mandatory, and if your IRA is large, those distributions can push you into a higher bracket, whether you want the income or not. Converting it earlier can reduce future RMDs and smooth your lifetime tax liability. Let's take a look at a case similar to what we often see utilizing our financial planning process. A client retires at age 62 with around $1.5 million in traditional IRAs. No pension. Social Security starts later, maybe at 70. For the next several years, their taxable income is minimal. Just dividends, maybe a little from a brokerage account, some interest. On paper, their income is low, but their net worth is high. That's the perfect window. We might recommend converting $40,000 to $60,000 a year from the IRA to a Roth IRA. Enough to fill those lower tax brackets, but not so much that it tips into the next one. The client pays tax now, but all future growth is tax-free. It also reduces their RMD burden later, which helps manage Medicare premiums and long-term tax exposure. Over 5 or 6 years, those conversions can start to stack up. The Roth grows. The traditional IRA shrinks. When Social Security kicks in, they have more flexibility. And by the time RMDs begin, the tax bite is a little smaller. This isn't about avoiding taxes, it's about shifting them to the years where they cost the least. This is the kind of planning we do every day for our clients, using strategies designed to fit real retirement timelines. That's what smart planning looks like. But it's not one size fits all. Of course, there's more to it than just taxes. We'd like to look at cash flow needs, your healthcare premiums, Social Security timing, legacy or estate planning goals, the size and structure of your investment accounts. Roth conversions affect more than just your current return. They influence lifetime tax exposure and how much flexibility you'll have later on. That's why we model with precision. We don't guess, we evaluate. So, should you do a Roth conversion? Maybe, maybe not. But the better question is, have you taken the time to explore it? Understanding how your future tax picture could unfold and what you can do now to influence it is one of the most overlooked aspects of retirement planning. It's not something you have to solve overnight, and it's certainly not something you have to navigate alone. We help clients walk through these decisions every day with clarity and confidence.